Learn price behavior, grasp the market advantage. Hello, this is Bella. Welcome to my instructional video series on price behavior. In the last share, we studied the simple callbacks of trends into field patterns, and today we further explore the complex callbacks of trends. We need to understand the question first: when the trend movement to simple pullback? When to give complex answers? If you remember from the last video, I talked about the premise of participating in a simple pullback trade. The first point is that there needs to be a strong movement with a clear price, preferably a big break out of a correction range or a band point. Here is the daily chart of US dollar to Canadian dollar. There is a simple pullback at the red arrow, and the entry of 2 higher is a multi-pattern. Let's first think about why this pattern is true, why we can do a simple pullback here, and why the price continues to rise after a simple pullback. This sharp rise, it's very strong. It has a very strong bull trend K line. Very long physical part, very little overlap. This strong rise, it breaks through a bottom structure, which you can think of as a box, you can think of it as a tube. Anyway, it's a bottom structure that has been breached very strongly. We're going to take the K line off the back of it, and for the major players in the market, they see this sharp rise and this breakout of a bottom structure. They know that a bullish trend may be starting, and that's a sign, so they continue to buy in a small pullback later. They are not willing to wait for lower positions to enter. There is a sense of urgency here. Institutions are rushing to buy, so prices do not pause much. Simple correction continue to rise. Let's briefly explain this second breakthrough entry mode, because many friends have doubts about this mode. Let's change the arrow to the top. The 3K lines, 2 EN lines, and a cross star line. The 3K lines are lowered in turn. Can you see? These 3K lines, the one marked by the red arrow is the high point. The first K line that goes up is the high point. The first K line that goes above the previous K line, it's the first break, it's high. And then the K line, its high goes down again, its low goes down, it's a high breakout failure. If we look at this K line at 2, it's the second time in the decline that the K line is higher than the previous K line. It's the second time that the K line is higher than the previous K line, and that's the second break. Does that make sense to you? One of my friends left a message below the channel, saying that the second breakthrough requires the reversal of the yin and yang candle. As I mentioned in the first video, each system has a different definition of these types. For example, some people think that the outsourcing line must be physical outsourcing, while others think that the outsourcing line does not matter if it is shadow outsourcing. For example, some systems think that if you retrace more than 61.8%, the trend is unhealthy. Some systems think that you can retrace less than 75%, and some systems think that you can retrace less than 50%. More than 50% is unhealthy. These are all so-called, they are the definition of performance. What I've been saying is don't care about performance, you have to understand the price, what's going on. What is its nature? So what happens to this second breakthrough, for example? Let's get rid of the K line at the back. This is a secondary breakout to the upside on the daily chart, so let's go to the 4-hour cycle. The small cycle can see that it is very obvious that the two forces of the long, the second breakthrough of the big cycle, the high second of the big cycle is the two forces of the small cycle long. Its nature is like this, there is nothing very mysterious, things very simple. Okay, so I'm going to leave you with the second breakout. Let's look at an example of a complex pullback, and this is the 12-hour chart of the Australian dollar versus the US dollar, where the red arrow is also a simple pullback and the box that's marked with a rectangle, it's now broken, and that box is a complex pullback. Some friends might ask why you call it a correction when there is no upward correction. In my analysis system, all of the collation patterns are called callback patterns, and that's one of the things I call them. Just so you get the idea. Why did prices continue to fall after a simple correction at the arrow? So if you think back to what I just said, there's a big range ahead and it's been going on for a very long time, and this sharp decline has broken out of that range very strongly and clearly, and at that point all the major players in the market, whether they're bulls or bears, understand one thing: it's much more likely that the market is going to fall, and that in this simple correction may be due to some short liquidation. Or it may be that some contrarian participants are entering the market. So in this round of simple pullback there are still the main bears in the continuous short. When a reasonable price is reached, the main short institutions will enter vigorously, so the price will continue to fall along the direction of the original trend. The reason for this simple pullback is the same sentence when the long and short participants in the market are in agreement. It is a pity that this round of simple callback brought by the continuation of the trend did not go far away. Energy is exhausted. It is also from a simple callback into a complex form. The price movement to this box place. Why the complex adjustment? Because this downtrend has been running for a long time, the main players that have driven this short market from the upper range have made a lot of money, and they are going to start to unwind their positions gradually. The second thing is that a contrarian trader is an institution that is on the sidelines looking at people who want to be long. In this position, they have more logical reasons to be long. For example, here's an equidistant down target. Let's move it over. We can see that there's an equidistant down target. So what else is there? And then there's this downtrend, which is actually I flushed this downtrend where the band highs are connected to the downtrend line and the band lows are connected. What about the two band lows? It's called the channel line of the trend, and in a downtrend the price falls to the channel line and it's easy to overshoot the market and reverse or adjust. We can see that there was a false break of the channel line, and then instead of an upward correction, it was a sideways correction, and then the channel line was broken down. It accelerated down, and then you can draw a second channel line which is a new two-band low. So what we see here is that the market itself has accelerated and it has broken through a new channel line, and that is that the market has accelerated and it has accelerated and it has gone too far, and that this short trend has gone too far in the eyes of a lot of people. And that's when a lot of people on the sidelines, long traders, they are actively participating in the market. They want to come in and see a significant pullback, like a two-step pullback or a three-step pullback to an upper target that makes a lot of sense to them, and that's the logic of a trade that has an advantage. So if we think back to the main players on both sides of the arrow, they all agree on the price, and they all agree that the price is going to go down. So when they go to the box, they don't agree on the price, and some of the bears think that the main shorts are always pushing the bearish shorts. They take profits at the bottom of the liquidating position in the box above, continue to short. They hope to put the price to lower, and outside the long has been waiting to see. They finally found a good long logic. They also actively participate in the market. At this time long and short both sides of the main point of view is not the same. The price here on the game, there is a pause. This is what we say complex correction. So just to summarize, if the direction of the price movement is clear and the major players in the market are on the same page, then you can have a simple correction where the players on the right side of the market are going to enter aggressively, and the players on the wrong side of the market are going to sit on the sidelines. And if the major players in the market don't agree on what's going on, if the judgment is divided, there will be a game where both sides are actively involved in the trade, and then there may be a complex correction. There are many forms of complexity and confusion, and today I'm just going to talk a little bit about what those forms look like, and I'll talk a little bit more about how they work in future videos. Some of them look like each other, and there's no obvious difference. You can call them this name or that name. It doesn't matter what you call them. Like I've been saying, the point is you have to understand what it means. Let's start with a two-step correction. A two-step correction, or what's known as an ABC correction, which is a very common pattern in market movements. Now I'm using a 1-hour chart of Bitcoin, and this is the most recent chart, and on the left there's a sharp pull-up, a sharp rise, which is very strong if you look at that rise alone, but if you look at the big cycle, it's very weak. I've shared it in the group and we're not going to go through that, but just look at this simple two-stage pullback, a sharp rally followed by a two-stage pullback. So that's where a lot of people come in and go long, but for my system, and I've shared it in the group, I don't have multiform here. Why? Because there are all these overlapping long K lines, and this overlapping long K lines is a kind of trading range that represents extreme uncertainty in the market. And I'm not going to go in and trade in that uncertainty. Now, as an additional point, and I actually mentioned this in the last video, we saw that there was a sharp rise and then there was a two-stage pullback, so the increase over here was actually the continuation of the previous rally and the continuation of the pullback, but as we get closer to it, the power to continue runs out. Remember what I said in the last video? The energy of a trend that is supposed to continue is depleted, and that is the potential reversal form that I'll talk about in more detail in the reversal film. So let's keep going, and then we can see that there are two big declines, and both of these big declines are actually two small pullbacks. So we can look at this one sharp decline, two sharp pullbacks, and then here it's also a two sharp pullback that continues a new decline. So the two-stage callback is a very common form in the market. A trend, we can go to see more. Now this is a chart of the 1 hour period of crude oil, and in this graph, there are two-step pullbacks. And some of you might ask you in the last video, didn't the pullback at the moving average, the pullback at the EMA 20 moving average, was a simple pullback? It's actually a simple callback and a complex callback, and sometimes the line isn't that clear. If you look at the 1 hour chart and it's 1M20. If you look at the 30-minute chart, isn't it a complex two-step callback? None of that matters. The important thing is that you know what the market is doing, and here's a little bit of information that you can try to understand. We see that for this decline, for this big decline, there's a two-stage adjustment, but if we look at the two-stage adjustment alone, what do you see? On the left, there's a rally, and this decline is actually in the mini cycle. It's a cycling adjustment, it's a habit adjustment. To the rally, it's a bull flag. And the rally continues after the rally is over, and what continues is the rally, as I said before, a continuation of this adjustment trend, which is supposed to continue the energy of the original trend, but it quickly dries up. Then it's a very bad sign, it's a potential reversal pattern. And in a pullback pattern you have a reversal pattern, and now you're going in the direction of the general trend, so it's a very good trade. This is the 30-minute period chart of the dollar versus the yen, and there's also a two-step correction, but it's a different two-step correction than the previous one, and it's a two-step correction that creates a trading band. So you can think of it as a two-step correction, you can think of it as a range. A lot of the patterns in the market are not the standard textbook pattern. Everyone is in one shape and there are many variations, and you just have to understand what the market is doing. And one of the things that we can also be concerned about here is that there must be a lot of people who are trading, a lot of weak traders who are trading this pattern, who are potentially thinking that this is a double top and they're going to trade this reversal, and that's actually very wrong. I've stressed before that you should assume that a move is continuous until it's clearly reversed, and that's only good for you. If you're a smart trader, a strong trader, a major trader, you know. They're going to be up here, they're going to be up here, they're going to see weakness at the previous highs, they're going to be short, they're going to be down a little bit, they're going to be waiting for this double top pattern to be established, but they're going to be short up here. Why would I know that if you were a trader, they would go short only if they broke below the previous band point? Because the back positive line is a very large positive line. This positive line has knocked out a lot of short sellers' stop loss. Now, three-stage corrections tend to form a wedge or a channel, and they're a very common pattern in the market, and they're very easy to trade, and I like to trade. Now this is a 4-hour chart of the euro, and I'm very impressed because I made a lot of money on this trade. I'm personally a day trader, and you know that, but it's a very attractive pattern, so I made a 4-hour cycle. Find the entry position in the small period, and then use the 4-hour level to position, so the profit is very big. So this three-stage decline, I'm going to clear this arrow right over here, and this is a three-step decline over a 4-hour period. And you as a price behavior trader, you should be able to see right away that the little period is a wedge, and you have to be able to practice that. So I'm going to go to the 1-hour period, to the little period, and I'm going to show you this wedge. Okay, I'm going to make this K line smaller. It was 4 hours, so what do you see now when you go to the 1-hour period? See a very pronounced 3-segment decline driven by a wedge adjustment. Going back to 4 hours and forgetting to mention the background, first of all, the background was a rise, and this rising channel lasted a long time, and then the channel broke down. So the trend that we broke down was the trend of our wedge correction. We came in at the end of the westbound correction, but we'll get into the details of how to trade this wedge later in the course. What about this new type of pullback that makes it very easy for you to have a very high break-even ratio, because your first target is the beginning of the wedge and your second target is the beginning of the sharp decline, and your entry target your stop loss, and you see that break-even ratio is very good. Let's go back to the big cycle, and the other thing to say about this trade is that it's a wedge of a pullback and I did it, but there's a gap in front of it and we see that it's also a wedge. But it's a wedge of an upward trend and it's an upward wedge, and that wedge tends to form a pullback pattern, so I'll talk about that later. It involves something a little more complicated, just the logic of the theory that leads to callbacks. This is the 1 hour period of the pound versus the dollar. And there's still a significant move down on the left and then a deep pullback, so this pullback is a three-way wedge pullback, and we can look at the three segments, the first, the second, the third. So someone might have asked, and this is where the aisle line is, and this is where the entry point is, so isn't this ticket damaged? It is true that the price has a brief pullback after extending the channel line and then a false breakout. If you come in here and you have a narrow stop loss, you get your stop loss shot, and then after this negative line comes out and this long negative line tells you that you were right, then you should look for another opportunity to come in and make a trade in this pattern. On the left, there's actually one more thing we can talk about. This is a speed and channel pattern that I talked about briefly in the last video, but you should be more familiar with this pattern if you're a member of the group. So what I'm going to mention here is that it's not the channel that's why this price has had such a deep pullback, but one of the reasons is the beginning of the pullback channel. And the other reason for that is that what I mentioned in the first few configurations of the video is this overshoot of the channel line. We can see a channel line connecting the low points of the two bands. We can see that the price accelerates after it breaks this channel line, and that acceleration quickly runs out of momentum, and you can do a lot of retrading and this kind of breakout of this channel line, and most of it is the last high and it's not very far. What about after the price has this kind of energy depletion movement, you get this kind of deep pullback? Another common form of adjustment is flag adjustment or channel adjustment. What does it look like? Why is it called flag shape? Because it looks like a flag. We can look at the previous rally as a flagpole, and then this adjustment pattern is a flagpole, and then the price breaks through this chess piece and continues the trend direction. What I shared in the group earlier is that if you as a price behavior trader you want to see the price performance of the current cycle chart, you should know what's happening in both the small cycle and the big cycle. This is the daily line of the pound against the Australian dollar, and when I see a pattern like this on the daily chart, I know it's a parallel channel with a little cycle, and that's a fantasy. How do you tell? First of all, we can see that this movement has a clear direction. It is a downward movement, but the downward trend is composed of many overlapping K lines, so it is a channel in the small cycle. How to distinguish between a channel and a range and a trading range? We can look at this segment and it's also overlapping K lines, but this segment of overlapping K lines where you don't feel any significant direction movement, then it's the trading range in the small period. Alright, let's go to the little cycle and see how this ride looks. This is the trend that we see on the daily line, and it's very easy to trade. We can take a look at it. About the entrance of the flag is generally breakthrough entry is the most common, or when the price touches the channel line, to enter. It seems to say that it is very easy. We know here on the break to do more, but in the actual operation you do not know which is the real break. Even if you in the channel line to receive the order, you could just get the ticket here and then this entry is a failure and you have to wait for the next entry. So how exactly to operate in this cycle, in this channel adjustment? We'll talk more about it later, but cycling adjustment is a very common adjustment pattern in the market. Let's look at another example. This is the daily chart of the pound against the Swiss franc, and then there's a question adjustment here. Let's go to the subcycle and look at it. In fact, this is a very difficult situation to trade. It has a lot of false breaks. Let's draw the upper and lower trend lines and the channel lines. We can see a lot of false breaks with leads. Then in the following order is also very not smooth, is very easy to encounter in the trading situation. That is to say, analysis and trading is really completely different. You analyze after the analysis that you can always find the real breakthrough trend. But in the actual trading you may be caught in the false breakthrough. One of the finishing patterns that we're going to talk about is this convergence adjustment and the adjustment of the box, which is a very common pattern in the market, and I think everyone who trades will recognize these patterns. It's also a very common form in Bitcoin, like the two that I've drawn here are both standard convergent forms. However, I personally rarely trade in this form. There are two disadvantages. The first is that there are multiple solutions when the line is crossed. You use the shadow line points to connect with the entity closing price to connect and then use the lead line to connect. The results are not the same. It is difficult to find the exact breakthrough point. The second is that if you go to a lot of trouble to find that really good triangle convergence and he ends up making a fake breakthrough, it makes it really hard for me to trade. In my early trading, I had a few setbacks in the face of trigonometry, so I rarely traded this form after my trading success. But for me, there are a lot of ways I can trade and I don't have to trade this one. And the advantage of that is obvious, because it's classic, so it's actually very efficient and everybody's trading this pattern, so it's efficient. It's the 1 hour period plot of gold, and then I also draw a very standard convergence pattern, so I won't go looking for that much and everybody should be able to find a lot of trigonometric convergence. In the future, I may also give you some advice on how to trade this form more effectively according to my trading experience, compared with the very common arrangement form in the market. I personally like to trade and have a lot of trading experience in the future will share with you. Most box breaks are pretty simple to trade, but this box in my picture is a little bit special, and I want to go deeper into it. We look at it in hindsight as a clear upward correction pattern, but what does it look like in real terms? Let me get rid of the K line at the back, and let's see what do you read in this disk. There's clearly a band point ahead where prices are moving rapidly, and there's a pause in the band point, and there's a box, which is a trading band that represents uncertainty in price. In fact, this position is very embarrassing for the trading, can be up and down the probability of 50%, but some people said this section of the rapid rise it as a box arrangement that it is a final form of the follow-up rise, probability is greater, but I have to remind you in front of a clear band point. The price of the rapid movement of the band point to a halt may also be a sign of momentum may be broken, that the box has become an end of the overall shape. So for a trader at the moment is very difficult to choose. And that's what I always say is that postmortem is not the same thing as actual trading, and a lot of analysts he talks about it in the postmortem, and a lot of new people like to watch videos of these analysts, and they think it makes sense and it's awesome. But you go and you talk about the past and you can't make money on the actual trading. When you trade, the plate is moving, not finished. Alright, so that's actual trading, and a lot of analysts he talks about it in the postmortem, and a lot of new people like to watch videos of these analysts, and they think it makes sense and it's awesome. But you go and you talk about the past and you can't make money on the actual trading. When you trade, the plate is moving, not finished. Alright, so that's it for today. We've mainly looked at various kinds of complex callback structures. We'll start the next video with a detailed look at each of these forms of trading. And just as a final digression, a member of the group has asked me if my video course is going to dissect the Allbrook's book, which of course is impossible because a bull system is so vast that every price behavior is explained in very small detail. He wrote 4 books with a combined length of more than 1.5 million words. I don't have the ability to dissect such a large system. A bull's method of price behavior analysis has had a profound influence on my own trading system. I will go over the points that I think are important. Even so, this is only a small part of the knowledge in the book. If you are interested in reading ABU's books and you have something you don't understand, you can communicate with me. Many people give up after reading ABU's books for a dozen pages, because there are many terms and analytical perspectives created by ABU. It is difficult to understand at first when you read the book. That's all for today's video, and thanks for watching. Please consider like and comment so we can keep you posted in the future.